There's a moment in every crypto cycle, one switch, one macro event that sends the entire market surging. Most people never see it. The, they chase narratives, influencers, hype, but they miss the one thing that actually drives crypto: liquidity. Today, I'm breaking down the liquidity cycle in 5 minutes and why crypto historically surges right after this one event hits. This is educational, not financial advice. High risk territory. You know the deal. Let's let's get into it. Number 1, liquidity is the fuel. Everything else is secondary. Forget hype, forget narratives, forget the daily headlines. When global liquidity expands, meaning money becomes cheaper, easier, and more abundant. Risk assets like crypto catch fire. Why? Because institutions stop holding cash and start chasing returns. Retail feels safer taking risk. Borrowing costs drop. New capital flows into every part of the market. And here's the truth nobody tells beginners: crypto doesn't pump because of crypto. Crypto pumps because the liquidity cycle turns. Number 2, there's one macro event that sparks the entire moves. Every cycle has the same trigger. Central banks shift from tightening to easing, interest rate cuts, balance sheet expansion, liquidity injections into the system. Where the Fed pivots, even signals a pivot, liquidity begins flowing through the global financial system. And every single cycle since 2011 shows the same pattern: liquidity up, Bitcoin up, altcoins explode, AI plus the pin outperform late cycle. It's mechanical, predictable, and completely ignored by 90% of retail. Number 3, crypto doesn't surge right away. It lags, then it moves violently. This is the part people miss. Imagine turning on a garden hose after winter. You hear the water moving, you feel pressure building, but nothing comes out right away. Liquidity works the same way. There's a delay between the Fed pivot, liquidity flowing into banks, banks lending, investors reallocating, capital flowing into high risk assets. Then suddenly the floodgates open. That delay is why most people get shaken out early. They expect instant results, but crypto's biggest moves happen months after liquidity returns. Number 4, the big surge happens when excess liquidity enters the system. Here's the key idea: crypto doesn't just need liquidity, it needs excess liquidity, meaning money that isn't needed for debt payments, money that isn't needed for safety, money that isn't needed for basic cash reserves. When that extra liquidity hits markets, this is what happens historically. Bitcoin leads the first leg, Ethereum follows, AI tokens and infrastructure plays outperform. Microcaps have their violent parabola late cycle. This is why every bull market feels sudden. It's not sudden, It's liquidity finally hitting the risk curve. Number 5, we're entering the most predictable liquidity window in 10 plus years. Here's what's lining up. Inflation is cooling, rate cuts are expected, global liquidity models are bottoming, yield curves are reversing, fiscal spending is increasing, AI investment demand is skyrocketing. You don't need to guess the exact bottom. You don't need to time every micro move. You just need to understand the cycle. When liquidity returns, crypto has historically surged for 18 to 30 months straight. Final word. This is the map. The timing is the edge. Thousands of investors chase narratives. Very few track liquidity. Liquidity is the wave. Crypto is the surfboard. If you understand the wave, the ride becomes predictable. This is education, not advice. Crypto is high risk. Always do your own research. Never invest what you can't afford to lose. If this helped you understand the game, hit subscribe. Tell me which macro signal you want broken down next, and I'll cover it in the next Alpha Signal Markets video. See you in the next video.